Get rich buying the dip. Here's the strategy, okay? Take notes. All right. The first thing you want to do is make sure that we are in a bear market. The way that you determine that is by measuring from the high to the current position using the ruler tool in TradingView. If it measures a 20% decline or more, we are in a bear market. If not, it has a little bit more room to go. But once we're confirmed in a bear market, we can now start to kind of predict where it's going to go. I'm going to show you how. Now, typically a bear market lasts a little over 9 months and it declines about 35% from highs. So with that information, what does that mean? Okay, once we get 20% decline, then we can say that, all right, it's going to probably come down about another 15% from where it currently is. Now, here's where it gets good. I want you to take the ruler tool again, and I want you to measure from 20% decline to 35% decline. Then I want you to take the amount of money that you want to invest into the market and divide it by 3. You're dividing it by 3 so that you can take advantage of the market at 3 separate places. Now, these 3 separate places are going to be support levels on the way down within that 15% distance from the 20% decline to the 35% decline. This is scaling in. Now, there's a few methods to do this. You can start with an even split, 3-3-3-3 if you're doing 10,000, 3-3-3-3, 3-3-3-3, right? And so forth if you're doing 1,000, you divide it evenly. Or you could backload it where you put 1,000 in and then you stack 4,000 on that to bring the average way down, and then another 5,000 at the end to bring it even more down. What this does is it allows you to get the best average possible, but I think I prefer the even Steven method because it allows you to catch it on the front end just in case we bounce before coming to the absolute bottom. Now, like I said, bear markets last about 9.5 months and they typically decline 35%. Now, check this out. Bull markets actually last about 4 years sometimes, maybe a little bit more. And at the height of its run, it's up 111% on average. This means that if you go from bottom to top, you on equity could more than double your money. If you're buying leap options that are set out for about 2 years, you could possibly triple or quadruple. This is crucial. And that's just on the stock market itself, like SPY. Some of your favorite stocks, when the SPY is down 20%, will actually be down a lot more, meaning there's even more money to make in individual stocks as opposed to ETFs. This is not the time to be scared. It's the time to lock in. If you need some help, comment below. I got you.